Hey everyone, if you have been listening to Empire, you know that Santi and I are fed up with unaffordable fees and frustrating transaction speeds that make the on-chain experience basically unusable. So the Arbitrum team reached out and they showed us the platform. They showed us what you can do on Arbitrum. Whatever you're doing, you can experience frictionless transactions at lightning speed on Arbitrum. So head over to portal.arbitrum.io and check it out. Scary stat for you. The odds of falling victim to online crimes are 1 in 4. Aura provides digital security protection to keep your personal information, passwords, online activity, and technology safe from online threats. For Empire listeners, Aura is offering 14 days free, plus up to 55% off an Aura subscription when you visit aura.com/blockworks. Terms and conditions apply. See site for details. You'll hear more about Aura later in the show. This episode is brought to you by Kinto, the safety-first layer 2 that features user-owned KYC and native account abstraction to solve the two biggest roadblocks to mainstream adoption. 1, security, and 2, user experience. Their founder, Ramon, sent me the onboarding flow. It's engen.kinto.xyz. I would highly recommend becoming a founding member of their launch program. You'll hear more about Kinto later in the show. Are you tired of high gas fees? Well, I'm excited to let you know about Skale, a zero gas fee modular blockchain that's become a perfect fit for gaming and AI apps because of their instant finality and lack of MEV. Explore the Skale ecosystem today at scale.space/ecosystem and stay up to date with the gasless blockchain on X at Skale Network. That's at Skale Network. Big thanks to Skale for sponsoring Empire. Hey everyone, welcome back to another Empire episode. We have Arthur0x on Twitter, but also founder of Defiance. We have Sean Lippel, GP of Fintech Collective, also poker extraordinaire. So yeah, Sean, Arthur, welcome to the show, guys.
Glad to be here.
Yeah, likewise. Thanks for having me here again.
Yeah, of course. Arthur, I want to pick on you first. So beginning of this episode, I want to talk about this idea of like low float, high FDV. Venture market seems like it's getting pretty out of whack, at least in the later stages. We saw like Monad, Movement, Barachain, like the speed at which I'm seeing like you go raise a Series A and then you turn around and raise your Series B, or you do a strategic round and then you do the series. It's getting very, very, very fast. And I'd love to hear, Arthur, you had this tweet. It said, the model is breaking. Merlin Chain last venture round was 800 million FDV, trading at 1.9 billion now. For Safe, last VC round, 1.2 billion FDV, trading at 2.8 billion FDV now, a 2 to 3x before any investors or team unlock. Tell me one more time that valuation doesn't matter. What do you mean when you said the model is breaking?
I think there was a lot of expectation among the crypto VC that as long as they get into any good deals and before the token unlock, they will usually see at least a 10x on the investment compared to the last round. For most of the infrastructure or layer 1, layer 2 project, they are able to raise at between 300 to 700 million valuation. They usually start trading at 3 or 5 billion valuation, and then if the market does well, they will trade up to like 10 or 15 billion valuation. In fact, that have happened during Q4 to Q1, right? We see Say Network went up to 10 billion. We also see Celestia launch at 2+ billion valuation and went up all the way to 20 billion valuation. So that certainly set the expectation very high. Yeah, but I don't think this is sustainable. There is more and more new project launching. A lot of them are definitely high quality project, but the money that is coming in to invest in these so-called altcoins are not keeping up with the pace of the project launching. So I don't think we are going to see so many of them launching and sustaining at between 10 to 15 billion on a fully diluted basis going forward. At least, even if some of them happen, it will be more like outliers rather than a norm.
Yeah. Can you maybe explain for listeners, maybe we can actually zoom out from that question, which is for those unfamiliar with this idea of like low float, high FDV, what does that really mean?
I think it really refers to where for a project that have a pretty high valuation on a fully diluted basis, usually refer to more than 5 billion at launch, where the circulating supply are less than 15 or 20% of the total supply. So there will be 5 to 6 times more supply that will be coming into the market over the next 2 to 4 years. Yeah, I think generally these are referred to some of the low float high FTV. Obviously, we have seen some of the even more extreme example in the past. Like I think some of these projects associated with SBF in the past, they would float at even less than 5% or less than 2% when they launched. So I think Serum at one point have 100 billion FDV, and the market cap was like less than 5 billion. Yeah.
So Sean, I throw this next one over to you, which is, do you think so Arthur's saying that this kind of like high FDV, low float model is kind of like breaking. Do you think that the window for launching a token and seeing that like instant 2 to 3x is now closed?
Yeah, it's a really interesting question. I don't think that's empirically been proven to be correct yet. I still think, I mean, expecting a launch out the gate at maybe 10x is probably a bit too ambitious. I still think, some of these new token launches are still coming at a minimum of 2 to 3x. A lot of it, as Arthur alluded to, is the fact that just a percentage of the circulating supply is actually out at launch, which creates a whole bunch of perverse incentives that Arthur unpacked a bit. Ultimately, like let's actually think about the incentives that are driving these type of outcomes. So for VCs, super helpful for them to get into a deal within a year, have the token launch, the ability to mark up their book, and then market to LPs that they've got a 3x investment or maybe a 10x investment. The problem, as we've seen, and this has been talked about at length on Twitter. You look at Wild, a bunch of other names. Since then, it's effectively been down only. And I think the perverse incentives here is if you're looking to actually decentralize the token, put it in the hands of more people, really tough for a regular retail investor to buy into that project, knowing that 80% plus the supply is the overhang essentially, and VCs will effectively be dumping on you. So I think something about this needs to be fixed. So I until the launches come at something less than 3x where VCs are entering, I think the dynamic will remain. But I'm with Arthur. I'm as concerned about this dynamic as ever, and it's why you've heard prolific chance of bring traditional ICOs back, where you could get retail in at the same price. So I mean, it's the market dynamic we're living in today, unfortunately.
So why is this happening, guys? So, and like the paradigm we're talking about here is like, okay, you launch the token at a high FDV, you've got like, I don't know, 10 to 20% of the token supply circulating right out of the gate. You have oftentimes no public sale, and the strategy right now is oftentimes big airdrop in this cycle. And we can talk about the points meta in a little bit, but yeah, you saw. I don't know, Arthur. Or Sean? What's a good example? Like Dimension, maybe it was like 8 billion FDV out of the gate, 16% circulating, no public sale, like over 100. I think it was like 100 million airdrop to folks. And I don't know what the price has done, but I'm not sure what it's done, but I would assume it's gone down. Why is this happening? Like, why is this the strategy? What does this accomplish for either the VCs, or what does this accomplish for the protocols? Like, if it's such a bad model, why is everyone doing it?
Yeah, I think it's really about the way that crypto does the anchoring, which I think that is you have a classic duration mismatch where you can't really just comb liquid stuff immediately with private market stuff. But I think that is something that a lot of projects have done. So like you look at, okay, let's say some of the liquid stuff has been trading at 10 billion fully diluted basis, but their circulating is way higher, like 7 or 8. And you launch something like a competitor, you think that they should have similar FDV, but the circulating are way smaller. And I think the market just shouldn't work that way. But unfortunately, this is how comparisons are being done, because you have Avalanche, Aptos, and Swiss are like a proper L1 are trading at 10 to 20 billion valuation, and it just lead to the anchoring of, oh, another very like high performance, like good team, like good project should also trade similar to that valuation at launch with a way lower float. So I think that it doesn't really give that project enough chance to grow into that valuation, which a lot of these older projects have a chance to get into. And another thing is, I think there's a lot of these like private bilateral agreement between the market makers and the projects, and probably within the exchange that we're not privy to. But in a lot of the tradition, so like a listing of any token is very similar to IPO, right? From market structure point of view. But in traditional IPO, the market makers are usually the investment banks, and the investment bank, they usually need to underwrite a certain amount of the um initial offering. So they are taking some risk with their balance sheet. If they are pricing it too aggressively, if it's down only, they will be actually be forced to like buying back. They're actually getting dumped on if they are pricing the IPO incorrectly. But in the crypto space, I do not think the market maker have such a risk. A lot of time they probably are kind of risk free. Either they do a pure servicing model where they're getting paid a retainer every month and they just provide liquidity, or they get a token loan to market make. But I don't think market makers suffer from financially from being pricing the anchoring the initial trading price too aggressively. They don't take the downside. But I think in
But
the
there are,
investment bank,
Arthur, there are some incentives. The way I understand it, and I've never been a protocol pricing a token working with a market maker, but the way I understand it is the market makers do get incentives for being able to keep the token above a certain price. Can
yes.
you explain that dynamic?
Yeah, so this is something more well known, which is like a token option. So let's say a token launch at initial was like a $1 price, they will give the market maker a token option like a strike price of $3 or $4. So if the token went above that, the market maker are able to exercise the options to buy a certain token at $3. Obviously, it's like a free call option to incentivize the market maker to contribute to the growth of the project. But I don't think I've seen any kind of contract where the market maker actually being penalized if they are setting the price on the wrong, because they do play a pretty big role in setting up the initial listing price and anchor price. I think generally three parties play a role in this: the projects, the market maker, and the exchanges, and obviously the market demand. But let's be honest, like the first minute, no retail is like setting the price for that. It's obviously always market maker. Yeah, probably Sean have a different color to add on this.
No, I think what you articulated is pretty correct. Like, I mean, I want to not be as finger pointy as say it's all incentives, and I think Arthur's right in saying sort of the reference point when you launch, like in building the imminence around the protocol, attracting more dev interest, retail interest, like all that flywheel works much better with a higher token price. Like that is indisputable. So you understand like incentives for both VCs to mark up their book at launch, plus just attracting retail interest and protocol devs to build on top of the project or the layer one. So it makes sense while you're kind of setting the price super high. Um, you know, thinking through sort of like the second order effects I said about just retail effectively getting dumped on. I do think the market structure that Arthur alluded to also is part culprit. I think like regulatory as well. I think most teams feel comfortable in the current regulatory apparatus, especially in the US, of doing an airdrop because there's not an actual exchange of monetary value for token. And I think unless we see a change in that regime or a stance by the SEC where teams feel comfortable doing that public sale, I continue to think like this dynamic will probably remain in place. Like we've not entered like the mature market structure with investment banks taking risks and underwriting. Market makers are very mercenary, and projects want high token price to attract interest. So I think you combine all that in the pod and we kind of are where we are.
Yeah, it's that two really good points there. One is I hadn't thought about the regulatory reason. So you used to go on like, so it initially started with ICOs, right? But ICOs, obviously, if you did an ICO today, like SEC's knocking on your door tomorrow. And then the other way was like, I mean, CoinList, like a lot of really good projects actually launched on CoinList, but I imagine maybe, I don't know what's happened with CoinList. I think they're still around. I saw their CEO tweeting about hiring crypto native folks or lack of it. But yeah, like if you think about how a lot of the most like the best L1s launched, it was like low FTV, like generally actually like a pretty fast unlock. So you didn't have these venture like token unlocks coming that people were worried about. Retail, I remember like you could buy some of the best L1s at like 200 million FTV or 300 million FTV.
Or even less, yeah.
And less, yeah. And then no airdrop. And you know, pre Uniswap, I think there wasn't really like a thing of an airdrop. So what do you think the what is the better model here? Like if you were advising a protocol, what is the better? Is an ICO the best model, but just don't do it in the US? Like what is the best model?
Yeah, so I think it's a combination of both. I think that the initial reasons for doing an airdrop is actually very powerful. You're rewarding the power users that were experimenting, like taking the risk of using the protocol before it become more like widely adopted. But at this point, it kind of become like a different game where there's like industrial scale farming, a highly anticipated protocol. So the point of being able to have a genuine airdrop to early users has probably passed. In many cases, I think it's still a very good mechanism, but in many cases that probably should not be the only way of distributing token initially. I think combining both is actually the best way. And I think that CoinList is still a pretty good platform. They are still conducting public sales. But obviously, the exchange are also still doing it, the Binance Launch Pool and Launchpad. But obviously, these are not enough to support the number of tokens that want to launch. And this is where we are ending up with right now.
Sean, what's your best model?
I think we're still in the trial and error phase of this. I think the pendulum has definitely swung too far. Like, think about all the slack that we gave Sam about the Solana launches with this same dynamic, and it feels like we've taken it and are now repeating it at scale. So I think decidedly we could say the pendulum swung too far. We're currently in a paradigm that isn't working for really anyone. So I think it is probably right to think about a combination that is both some sort of airdrop, but I am actually a proponent of the points schemes, and it's been pointed out, like at least from the lever respect, like you can, a certain type of activity that is not beneficial to the protocol, like in real time, you could course correct for that, right? And the type of activity you want to incentivize, you could also incentivize it based on the point scheme. So I think a point scheme, but I don't think a 1 point in time airdrop and that is it. I think that leads to industrial air farming. So you want to have an approach that kind of combines all these things. Maybe it's a CoinList list, and it's folks that have been involved in the community, have contributed to the protocol in some way that kind of like secures your seat in the CoinList offering. And maybe you do like 5 to 10%. That way you do 5 to 10% upfront in an airdrop. And Jason, you also alluded to like what you're seeing is like these large unlocks that the market has pretty good visibility into that come over time, and they're kind of like stair step functions. And I think probably the deals that we've done that I probably feel most comfortable with are like almost like daily vesting over maybe like a 4-year period of time. It kind of smooths out that curve in which you don't get this precipitous like drop in price and a huge unlock happening at a specific point in time that can be gamed in many respects, which I think actually lead to even bigger drops. So I think like aligning both the team and investors, which usually are about 30% of the total supply, having a more linear supply schedule plus an airdrop that's more points based, that similarly like maybe doesn't unlock right away all up front. I think some sort of combination of that. Like I said, I think by trial and error, I think we will arrive there. But unfortunately, it's this mix of incentives and probably the regulatory side that kind of puts us in this current paradigm.
Yeah. Sean, the other thing you mentioned a few minutes ago was just that folks want to get the highest valuation possible. And I don't know, what it feels like what's happening right now is like whenever I see a founder maybe raise like their series A at, let's call it 10 billion or 5 billion or something, like you got two things come to mind. One is Definity or ICP,
Hmm.
right? And two is some of the SaaS multiples that we saw in 2021, where SaaS companies were raising at 100x valuations, which I don't know, it feels really freaking good in the moment because you're like, oh my God, I just created this $10 billion company. But like it is I don't know, like 9.5 times out of 10, that's going to end horrendously. So I'd be curious how you think about, like, maybe Arthur, I could pick on you for this one. Like, if a founder comes to you and is like, let's say they raise at 300 million valuation back in January. They're like, Arthur, I've got a term sheet from Andreessen, 5 billion. And it's like 3 months after they raised at 300 million. What are you advising them to do there?
No, I think from a founder perspective, they should definitely take it. From their perspective, they can obviously there is always a big risk of raising an evaluation you don't deserve. I'm saying this from a perspective that the project probably are quite close to deserving that valuation. They should definitely take it. You give them more cash to do this, but it's really about how they should manage a launch. And like I don't think that they should raise at like 5 and then immediately start to launch at 5 as well. I think at least the current market structure is not receptive to like the public, and it's all happened in the stock market as well. The public market and the private market price things in a very different manner. So if you decide to do that, you are gonna get a lot of issue in the public market. So the founder will need to pay attention to how do they balance how the public market will price this versus how the private market is pricing it right now. Because right now the gap is big.
All right, guys, maybe just continuing with the valuation conversation. We had Kyle from Multicoin on the podcast the other day, and we were talking about just like different ways to value a crypto asset, and the way that they think the way that they think about this at Multicoin is a lot of it is based around MEV. Actually, Kyle was on the podcast, but Tushar had a great talk about how MEV is the only way or the best way to value a crypto network, which is kind of a controversial take, I think. Would be curious to get your guys' take on like just how you think about valuing a crypto asset. Like, there's the DCF way, there's like
Yep.
fundamentals with like fees and emissions, there's MEV, there's like none of this matters and it's just what the narrative is. There's like, you could play it based on comps, you could play it based on like where we're at in the cycle. There's like actually a lot of different ways that people think about valuation. So would love both your takes on this.
Yeah, I'm happy to kick it off. I completely understand the logic of thinking about MEV, and I do think that squarely fits Yano into the capital asset way of valuing crypto assets. I think it's correct if you play this out to its steady state and you believe that there's infinite block space and all block space is inherently created equal, then probably at that state, MEV is probably the only thing that matters. I think empirically, what we see is that block space is not created equal. Like block space on Bitcoin is valued differently than block space on Ethereum, is valued differently than block space on Cardano. Um, so I think it's tough to sort of make that attestation that MEV is the only thing that matters. I think even with things like Solana, like the blocks are now almost completely full with increased activity. So things like priority fees and base fees like do get you squarely into a capital asset way of valuing things that are more DCF that take into account things other than just MEV. But more importantly, I think like the overarching point I would make is that I think the vast majority of value creation, when you think about layer ones and even layer twos, don't really come from just the capital asset way of valuing, of just looking at like discounted cash flows of MEV and fees, both priority fees and base fees. I think it really comes from the commodity way of looking at the asset. I think there'll be 3 to 5, big winners in the layer 1 space that get valued as money. And I think the TAM of just like M2 and money, and even if you think about gold in that respect as well, so M1, M2, like that TAM is much more sizable, and looking at it as sort of a store of value and a commodity, I think is probably the more correct way of valuing this, as long as like blockchains are not homogenous. And I think we're a long way from block space being homogenous. So I think MEV is an input into the valuation model. I just don't think it's the end all be all in its current state, or for a while for that matter. And I think just one point to add, like, just look at like in aggregate what the totality of MEV is across all blockchains. Like, we're not even talking in the tens of billions yet. Like the total value of layer 1s is is many trillions, right? So like you can't apply a multiple to MEV today and kind of arrive at any sort of sensible valuation. So that kind of indicates to you there's at least 1 or 2 other factors at play that are commanding a different valuation multiple.
Yeah, I think that's extremely good point. And actually, after spending close to 7 years in crypto and in crypto investing, I've come to realize that actually valuing crypto is actually an alpha in itself. Because there is no universally agreed valuation framework. So whichever investor they are able to best figure out the appropriate valuation framework for different crypto assets will be able to generate excessive returns. Because I think that is actually what happening to the market for the past 6 to 7 years is every different kind of cryptos are being valued in the different manners. Like Bitcoin, obviously, like a lot of the ETH Max they always say, Ethereum generated more fees to the token holder, ultrasound money. Like we have like negative inflation, all those things, all better than Bitcoin every manners. So why is Bitcoin worth 4 times more than Ethereum right now? So because the valuation framework people use to value Ether and Bitcoin are different. People see Bitcoin as largely a monetary asset. People still do not view Ether that way yet. Can ETH get there eventually? Very likely, yes, but it's not there yet. So the people are not applying the same valuation framework people use to value Bitcoin to Ether yet. And it's the same thing with DeFi, with layer 1, layer 2, and also other tokens. So I think that we actually have gotten big enough as a space that different sector of crypto are being valued in a different manner. And obviously, unfortunately, DeFi is the easiest to value because usually the protocol produce some sort of revenue and cash flow to the protocol, and it's the easiest to apply kind of like a traditional valuation multiple to DeFi protocol. And also, I think that actually, unfortunately, set a ceiling on the valuation of most DeFi protocol. It's just because it's the easiest to value. That also means that it is the hardest to put like a extremely aggressive assumption on it. So I think that like for meme coins, I do subscribe to the theory that it's really should be valued as so-called attention theory of value. Like you really value it by attention. It's really not about the cash flow or whatever. For layer 1, it's a combination of the growth of the network in the future, and like how much user is the user base. You can use a combination of Metcalfe law plus the monetary premium the layer 1 token is gradually accruing. For Bitcoin, it's probably 95% monetary premium. And then you have other governance token that, and like probably like the value, the cost of attack. So I think different category of token, you need to use a different valuation framework, at least for now.
All right, I'm gonna play a little game here. I'm gonna make you guys do I want to see how I'm gonna pull up 2 charts. One is ETHFI and one is Lido. Are either of you guys investors in either?
We are invested in Lido. Yeah.
Same here.
Okay.
not ETHFI, but Lido.
Yeah, not ETHFI.
All right, I mentioned them in the pre-roll. Now I'm going to bring them up again. It's Arbitrum. Santi and I are really fed up with these high fees, and we're really excited to have teamed up with Arbitrum for the next couple of months on Empire. As the leading Ethereum scaling solution, Arbitrum now powers hundreds of decentralized apps across DeFi, perps, NFTs, gaming, and a whole lot more. The team has showed us everything in the ecosystem, both now and what's to come, and we're really, really excited about it. Arbitrum allows both daily users and developers to interact with Ethereum at scale with low fees and faster transactions. The way the team got me excited was through portal.arbitrum.io. So my call to action to you is to get started by visiting portal.arbitrum.io. Go experience on-chain like it was meant to be. This episode is brought to you by Aura. Online crime is growing at an alarming rate, and cyber criminals continue to find crypto investors like the Empire community lucrative targets. We've all heard of someone who's fallen victim to some sort of online attack. Aura helps prevent against that. For example, if your online accounts or your passwords were leaked online, or if someone tries to open a bank account in your name, you'll get notified in real time about that. With 24/7 US-based support, Aura's team will be there for you to resolve fraud issues, even if it means getting on a three-way call with your bank at midnight. Not saying I had to do that, but I might have had to do that. So aura.com/blockworks. Sign up for the 14-day free trial. Terms and conditions apply. See site for details. Aura is the new standard in digital safety. Check them out. aura.com/blockworks. Free 14-day trial. This episode is brought to you by Kinto. Kinto is a safety-first layer 2 that features user-owned KYC and native account abstraction to solve what are probably the two biggest problems in crypto. 1, security, and 2, user experience. I'm an investor in Kinto. I've known their founder, Ramon, for a long time. Ramon, the other day, sent me a message on Telegram and said, you got to try this onboarding. I'm super proud of it. Please just go ahead and try this out. Tell me what you think. It is the most magical, seamless onboarding experience onto an L2 that I've ever had. You can try it out. It's engen.kinto.xyz. I would really recommend going through the whole onboarding flow just to see what the future of crypto can feel like and what it probably will look like in the future. Go onboard, engen.kinto.xyz. Let me know what you think. And if you want to chat with their founder, Ramon, happy to make the intro. Hey everyone, Jason here. I know you've been hearing a lot about the intersection of crypto and AI, and that's why I'm really excited to share our newest partner and sponsored empire, Skale, a high-performance modular blockchain that's revolutionizing gaming and AI. With zero fees and instant finality, Skale's unique architecture allows for massive scalability and has already saved users over $6 billion in gas fees. The 5 main takeaways that you need to know for Skale: 1, zero gas fees. 2, Skale has instant finality and lack of MEV. 3, the zero gas fee model of Skale is really important for blockchain gaming adoption, as gamers don't have to pay transaction costs or have the SKL token. 4, Skale is multi-chain. This design allows for nodes to be combined to create chains and for individual subnodes to actually be removed and relocated, which creates greater security and collusion resistance. And 5, Skale has become a really good fit for AI dApps because they're fast, automated, zero fee transactions. Big thank you to Skale for sponsoring Empire. We're excited to partner with you guys. Bridge over to Skale if you're listening to this at scale.space/ecosystem. Follow the journey along with Skale on X at Skale Network. That's at Skale Network. Big thanks again to Skale for sponsoring Empire. Okay, so I'm going to pull up 2 charts. I'd be curious for the retail investor listening or for the venture investor, whoever it is. How would you think about, so here's how would you think about like valuing these and comparing these? So this is ETHFI. FDV is 3.8 billion. Market cap is 440 million. So this is maybe kind of what we were talking about earlier, like very high FDV, but like a lower float. So the market cap is 440 million. Lido, on the other hand, has a smaller FDV. So their FDV is 1.9 billion. And their market cap is 1.7 billion. So much tighter like market cap to FDV relative to ETHFI. Sean, and I don't know who to pick on for this because you're both invested in Lido, but yeah, what do you guys see when you see these charts and these numbers and but then you also have to consider the narrative and where we're in the cycle and the restaking narrative. Like, how do you guys think about this?
Yes, I think there's multiple parts to this question that involve that really force us to kind of like look to the sum of the parts and really break down like first starting with like the business model before we even get into like a valuation framework, right? I think I kind of push the team and here internally, like, let's just like think about this as you would any other traditional SaaS business. before, and like, what does Lido do before we even get into like how to think about valuing it, right? So if I think about Lido, like, there's 30 billion total, ETH, staked via Lido. Obviously, there's 28 operators plus behind that. So think about it as like a $30 billion asset manager, right? And like, to me, as like a former fintech investor, I look at like Betterment, Wealthfront as kind of like the parallels or corollaries to what Lido does. And think about like, of that 30 billion, right? Look at sort of like the ETH staking yield, which like if you include MEV, priority fees, call it, somewhere between 3 and 5%. So, when I'm walking through effectively is, the DCF calculation for Lido. So you look at that, you say about, 5% times the, 30 billion in total assets under management. You arrive at, maybe somewhere like $150 million of total earnings that goes to Lido, as we know, because they take a 10% fee, right? Of that 10% fee, only about 5% goes to the actual DAO, right? And in that, like, that goes to pay expenses. Effectively, if there's more retained earnings, that could go to something like, distributions or dividends, or effectively what Maker does of buying back the token. So here you have like a pretty simple model as it exists today of what Lido does, right? It's the leading liquid staking protocol, of total liquid staking assets. It's got about a 70% market share. It's something that we look to and, are excited about, because we think effectively what's happening within DeFi is what's emerging as effectively the Magnificent Seven, or, monopolies with, real moats around their business, around, things like liquidity, etc. And then, so that's like the very straightforward way I just gave you about valuing Lido. I think that's one piece of the puzzle. But as we know, like, market prices, like that's what's priced into the market today. But like what effectively moves markets is, inflection points or changes versus expectations. And I think one of the things I think about with Lido, there's, a lot of things happening under the surface that gets me excited about the next catalyst for Lido. To me, I think, you pull up the ETHFI chart, and, you see something at 5 billion, and how's that trading that way? Like, we don't know what AVSs are live today. We know there's some sort of base staking yield that EtherFi will have, and maybe on top of it, there'll be some AVSs live, and stakers will receive some percentage of that security budget. You're basically betting on the future, right? And the current price of this anticipates that like the shared security budget and the amount of rewards being generated by those AVSs will be large. Now, let's go back to Lido. I think it's pretty obvious to me that at some point in the future, Lido, while I don't think they will create a direct competitor to Eigenlayer, because I do think the projects are pretty close, but I think it's pretty simple for them to turn on an LRT or 3 different types of LRTs, right? So like you're taking on much more risk, maybe your medium-term risk, your low risk, depending on how much slashing risk you're willing to take, or like what type of AVSs you feel comfortable getting involved with. So to me, like what excites me about Lido is they have a really dominant market position at 70%. And, thinking about the inflection point, like highly likely in the next year or two, like they don't need to disrupt themselves. They have a market dominant position, but they will turn on an LRT in some form. And you'll get this effective re-rating that to me can move, Lido 2 to 3x higher from where we currently trade today. So what you're seeing is a bit of like, the fundamental analysis and like valuing it like a traditional asset. But also like the expectations of the future and what kind of moves prices on a go forward basis. And the last thing I would say is just like also thinking about, like capital flows. And to me, it's like fundamentals only matter to the extent in which they show up in capital flows, right? It's like you could talk about fundamentals all you want, but until, the protocol is effectively buying back its own token and it shows up in capital flows, or other investors are, also circling around your valuation methodology and start buying the token based on it, it just doesn't matter. So, I think that's one thing you've got to be like super, super thoughtful on when thinking about entering these positions.
Arthur, before picking on you for the same question, Sean, what is the Magnificent Seven that you mentioned?
Yeah, so thinking about just like when I kind of zoom out and think about like businesses, especially on-chain businesses, like I'm biased, I run a DeFi fund. To me, I think about, businesses that have, durability and defensibility around their business model, whether that's things like liquidity moats, like, staked ETH, it's like the predominant pair. It's kind of been accepted almost as much as ETH itself. So we look at like companies that kind of mimic what you've seen in the Magnificent Seven in the traditional equity market, are companies that like are high, like have very high margins, are very profitable, and have big competitive moats around their business. So I know it's been talked about before on Empire, and what's referenced as like smell. I think we have a different variation of what we would put in that, of like businesses on chain that have big competitive moats. But I think about things like Maker, things like Uni, things like DYDX, things like Lido, which to me represent the Web3 versions of the Magnificent Seven in sort of the Web2 world.
Smell being Synthetics, Maker. I think this was actually Vance, maybe, who coined this. I think it was
Yes.
Synthetics, Maker, Ethereum, Lido, and Link. I want to say.
Yep.
Yeah.
Yes.
Yeah. It's a good narrative for the. Yeah.
And I would just, I would just add, like I kind of would say like we need, that version of things to kind of work out like a rise under tray for fund managers to kind of exist. Because if not, it's like,
Right.
why not just invest in Bitcoin? Like you've got a form factor in the ETF, like effectively, eventually the Ethereum ETF will come as well. Like if there's not outperformance and, moats around some of these business models, then it's super tough. Then we're just playing the like, we just need to be early game, and just get in early, launch at a high valuation, and get out.
I mean, I've brought this up on Empire numerous times, so listeners are gonna be sick of hearing me talk about this, but like this is what we think about it. So we have this we have a Blockworks research platform, right? So, and you can see like these metrics that you can't find anywhere else in the industry. Like we have the full P&L of Maker with like where all the revenue comes from, like entire income statement. And we're like, oh my God, this is like incredible information. You can look at like DAI metrics. You can look at like you can look at like all the RWA information. You can look at Spark protocol. Like we've got all this amazing information. The question is, does it matter? Does it move? So like Maker today is doing something like 40% of the fees in DeFi are going to Maker. Does that move the token? Arthur, what do you think about that?
Yeah, so I think that this one unfortunate big picture situation is the last 10 years, the market as a whole generally like growth a lot more than value. And people see DeFi, especially the DeFi, so-called DeFi blue chips, as more of a value play than growth play. I mean, there are exceptions. There are some DeFi protocol that show a lot of growth, but those are the exceptions. So I think for Lido, most people see it as a value play. And the problem of value play is people do not assign a very high multiple to it. While ETHFI, because they are still at the very relatively low in terms of the market share and everything else, they are perceived to have a higher growth potential. So people are willing to assign a higher multiple to whatever revenue and the TVL they are having right now. And obviously, again, we mentioned that the float is a lot lower. So it's a lot easier for market to support like a 4 to 5 billion valuation for ETHFI versus like a 4 to 5 billion valuation for Lido, where more than 90% of Lido supply are already circulating. And another thing that I think is also like, I think Matt Levine in his newsletter have also mentioned that we can't enter into a situation where fundamentals set the floor for a valuation, but that actually doesn't set a ceiling. So that creates a situation where for certain asset that the market is super excited about, the people are willing, the ceiling will go up. Yeah, so we can argue that the ETHFI will have a lower floor in terms of the valuation than Lido, but people are not looking at the floor right now. People are looking at the ceiling of ETHFI. So in the short term, until more and more supply of ETHFI is being released to the market, you might see this so-called mispricing sustained for a pretty long period.
Yeah.
And also, I think that in general, this market doesn't have that much liquidity to support more than 50 assets to trade at more than 10 billion circulating market cap. I think this, at least this is an empirical observation. The market simply doesn't have the liquidity to support that. So I think that 1 month ago, somebody also pointed out the observation that the peak of the valuation ceiling, even including the new launch can go recently, it's like 25 billion, excluding WorldCoin, because of the float is even like less than 5% or like 2-3% kind of float. I think that at least empirically, the market right now, beside Bitcoin, Ethereum, Solana, and probably some of the legacy dinosaur coin like XRP, we do not have the liquidity to support any new coin to go above 10 billion in circulating market cap and above 25 billion in fully diluted valuation.
You agree with that, Sean?
I think that's probably right. I am worried about the amount of unlocks and inherent like token emissions coming into the market over the next year to 2 years because of this dynamic that we're talking about, where only 20% of supply is being released. And I do think, just given, like, if you look at the total aggregate amount of institutional capital in crypto, I would say it's 10% or less of like proper institutionally organized capital. And you could argue like retail in crypto is generally smarter than retail in other markets, which I think is correct. But it tends to be more mercenary, not long-term capital. So I think it's really tough in that backdrop to support valuations north of what Arthur alluded to. So I would say, like, loosely that's probably correct, and it's a function of, one, just how early we are in this space, and people are still figuring out what valuation methodologies to be using, and it as we talked about, varies depending on the asset we're talking about, like whether it's a layer 1, a DeFi protocol, or an application. So there's just confusion around that, but just the more retail capital, and then just like fragmentation of just interest. And it's really tough, like when you're seeing the proliferation of more and more projects launching. Like, how many LRTs do we have? Like, I've probably seen a very similar pitch, between Kel, Puffer, ETHFI, Swell. Like, we have 10 plus LRTs that are launching to the market. Can the market support like 10 plus $5 billion ETHFIs? That feels like very ambitious to me. So I think it's tough. So I am worried about not just like the launch dynamic, but like kind of the emissions that are coming to the market over the next 1 to 2 years, because it just doesn't feel like there's enough new capital coming in to support it.
Yeah, and also I want to add that I actually pointed out this issue 2 years ago, and unfortunately it hasn't changed. Is the crypto capital market have actually front run the phase of market development. What I refer to this in a traditional financial market, the emergence of a private capital came pretty late. Actually, it was the last bunch of players. You actually started with obviously every market started with a heavily retail dominated market, as is US stock markets 70 years ago, 50 years ago. Then what happened? You have the professional investor that come into place. Who are they? They are the mutual funds. They were ever active in the public market. They were doing the stock picking. If you look at the legendary investor 30 years ago, 40 years ago, they are all the public market legends like Warren Buffett, Franklin. There's a few others as well. They're all stock pickers. And the success of VC and private equity came last. And obviously, you also have hedge fund that were like came after the mutual fund become successful. But in crypto, we actually completely skip over the formation of mutual funds. So there was a very under allocation into public market investor, pure public market investor, except for retails. You obviously have a couple of hedge funds here and there, but hedge funds are not long-term holders. They usually trade in and out. The average holding periods are like weeks to months. Nobody's holding a position on like a months to year. I would say yes, there is. We are seeing more of them coming out. But if you talk to any institutional investor, they all overwhelmingly invest into venture fund, than to like a public fund, like more like what us and Sean are doing, like more medium term kind of like a public market focused fund. It is I would say that the split of allocation of capital is probably 80-20. 80% are going into VC and 20% are going into public market focused fund like us. And even, I mean, granted, we know that some of the big VC, they also buy from the private market, but they do not look at it from like a public market guy lens like us. They do it as like on a deal by deal basis. Okay, I like XXZ, they bought a tons of Lido in 2022, but they don't really like, actively manage a position. They would just done the deal, put it, I'll look at it 3 years later, 5 years later, whether I should sell or not. So you don't have, it doesn't help to encourage this kind of efficient price discovery in the public market. You have retails versus the hedge funds, some smart monies, and the VCs selling on the market to cash in their 10 to 50x returns. That's it. And the founders. Yeah.
Yeah.
So I do think we need more and more of these public market focused professional investor so that market can become more efficient. I think it is happening, but I think the ratio is still not at the level where we can catch up. Yeah, compared to private capital.
Yeah, I mean, I just think it's a sign of a growing industry. Like there are I'm seeing a lot of market neutral or delta neutral hedge funds launching in the industry, where they're traditional capital markets guys coming in just saying this is an inefficient market. I don't give a damn about crypto assets. Like I'm just going to try to launch like a market neutral fund. And at first I was like, man, that is like about as left curve as you can get. Like that is just, come on guys. But, and I still actually kind of believe that, but also it's a really good thing for the industry to have folks like that coming in, trying to help the market find like more of a equilibrium price. So now, would I be in crypto trying to make like 15% a year? Probably not, but yeah. What else? I don't know. Can you guys share what else you're invested in right now? Is that like a thing that you can talk about publicly or no? I'll take the deafening silence as a no.
No, we can talk about it. Yeah, Sean, you can go first.
We can talk about it with the caveat, obviously, that you always put in every show, Yano. Like nothing here is financial advice. Because we are a registered SEC investment advisor here in the US. So obviously, my compliance officer, heavy disclaimers on.
They're like, Sean, you're doing so well on that podcast until you just had to go pump makers bags. Just kidding. None of this is financial advice. You know the deal. Yeah. All right.
How'd you know about the position I was about to talk about? So what's most interesting, because like we kind of straddle both worlds. Like I do some early stage pre-token launches, which I would say today are mostly focused on burgeoning DeFi ecosystems outside of Ethereum. Because when I think about Ethereum in DeFi, the core building blocks of stablecoins, borrowing, lending, perps, decentralized exchange, like to me, like there are ossified winners within those spaces. And like, yes, we're invested in many of them, like Uniswap and Lido. And I could give you our maker thesis. I would say on the pre-token launch side, I am a believer, despite everything we talked about of, there will be, I think it's indisputable, we're in a multi-chain future. And, DeFi is sort of the lifeblood or lubricant behind all these other ecosystems. And I think about just like more types of assets coming on chain on other layer ones. So, I am excited actually about the Bitcoin layer 2 space. I do think, that will usher in new DeFi protocols, like things like Bitcoin potentially having a stable coin on its rails, things like native yield on Bitcoin, the ability to borrow and lend, in the absence and collapse of Genesis, like there's still a big gap to be filled. That was $100 billion plus market. And I think we could do it better using the power of smart contracts and what Ethereum has done. And we're way further in the, scaling roadmap and being able to import some of the learnings around ZK proofs and optimistic rollups into the Bitcoin ecosystem is very real. And I think, there is actually tremendous demand you're seeing with ordinals and runes to have activity on Bitcoin. So I think about a robust DeFi ecosystem developing on Bitcoin as some of the earlier stage stuff I'm interested in. No, I've talked to you at length also about the Filecoin ecosystem. When I think about like probably one of the leading DePIN architectures. Supply side for storage has been built out with the advent of the FEM, so the ability to actually have smart contracts on top of Filecoin. We're investors in something called Glyph with Multicoin, and I'm very excited about the ability to sort of connect storage providers with idle Filecoin holders who are looking for yield on their assets, so very efficient capital markets in Filecoin. So we think about like basically solving first order problems of these new ecosystems. Similarly on Avalanche, right? I personally am the belief that Avalanche is a more actionable, version of what Cosmos is trying to implement. So we're investors in something called GoGoPool, which is another liquid staking primitive, which just makes it much easier to spin up your own sovereign subnet without the same level of capital cost up front. And like I said, liquid staking is proven like it's just, a much more efficient use of your capital. It allows you to then do more with it after. So kind of replicating that playbook of liquid staking across a bunch of different ecosystems has been something that's very interesting to us. So I would say on the earlier stage front, very interested in the burgeoning ecosystems of DeFi and other ecosystems. I am actually, I know this is something that's been talked about at length, but also we haven't seen demonstrable evidence of it working. But I don't think it means it won't work. I do think there'll be permissioned versions, whether that's layer 2 permission versions or permission protocols of the same things we see work in permissionless open source DeFi. Yes, Aave had to run at it, Compen had to run at it, but I'm actually the view is probably pretty early. Like a lot of the tooling was not yet in place. And I do think, even like it may be like heresy to say this, but things like rollbacks on a layer 2 and a more institutional version of a DeFi protocol, like actually might be the right way of doing things. So a permission KYC'd version of a layer 2. And why now? To me, it's like we didn't have the building block of stablecoins here before, like the proliferation of stablecoins, how widely they're used, and 12 trillion in settlement. And we just have way more yield bearing stables. We have more real world assets coming on chain with things like Biddle and what Centrifuge is doing with some of the private credit. So there's just more assets to trade today that potentially can be traded on a layer 2. And I do think, at least if there's KYC AML in place, for the vast majority of institutions, they will actually be able to, play in that sandbox or begin to explore. Today, without, some version of KYC AML, super tough for definitely no bank is going to get compliance approval to participate in DeFi, and only those who are like playing on the forward end of the risk curve and more, some of the more Chicago trading shops are willing to experiment with DeFi. So I do think that is a narrative that will come back despite people having a run at it to varying degrees of success.
Yeah. Arthur, I'm going to adjust the question a little bit for you. So when I think of Defiance's, actually, when I think about the wealth of a lot of the venture firms in the industry, a lot of them were made on the back of 2 to 3 bets. There's 1 or 2 venture firms that made most of their money on Near. There's a few that made a lot of their money on synthetics and Chainlink. There's a few. And when I think of Defiance, it's probably Aave, just correct me if I'm wrong, Aave, synthetics, and Axie would have to be my the overwhelming portion of Defiance's wealth and AUM at one point in time came from those 3 bets. So A, I mean, correct me if I'm wrong, but B, when you what maybe 2 to 3 public market investments do you think could have that same impact for you in this cycle?
Yeah, that's a tough question. We've been thinking very hard as well, and I think you're largely correct. I think that 3 investment was one of our best investment in the previous cycle, in the previous fund, and I think this cycle is harder, and I think that's the honest answer. I think that the market have gotten a lot more efficient. During the 2021 cycle, we attracted a lot of the smart and bright people into the space. There is a lot more, every different sector, there are very smart people paying very close attention to it right now. So I think it is a lot harder to find like 100x, like a 50x kind of public liquid play right now. So we actually a lot of our time right now, we are actually spent on help thinking there's something that we think that is actually undervalued by a factor of 5 to 10 times. I think that is a lot more achievable. And I think this is really where our liquid venture thesis come in, that we are actually that's the thing, right? A lot of VC they probably wouldn't really care if they can only get like a 5 to 10x return from the point of investment, unless you're like a big fund. Because like it's not enough to carry the loser you have on other investment and go to zero or just like break even basis. But as a liquid fund, because we are able to turn over the investment within like less than 2 years or even less than a year, we are happy with like a 3 to 5 times or even like between a 5 to 10 times return is actually good enough for us to underwrite the risk. So we are a lot more focused on these return sectors where we get like a 5 to 10x within a 1 to 2 year time frame. Those kind of opportunity, I think, is a lot more available in the market right now. And in that sense, right now, I think there's the two sector that we think that will continue to surprise to the upside. One is Web3 gaming. Uh, the second one is DePIN, decentralized physical infrastructure network. Gaming, because it's still controversial. I think that there was a lot of information asymmetry, a lot of misunderstanding, but it is also has been proven to be the sector that can generate one of the most cash flow, and also are able to bring some of the best onboarding tools for masses into crypto. But I think the game that take off probably would not be what we have imagined in the past. I'm leaning more and more toward that you cannot be skeuomorphic in your product design principle in crypto. Like you can't just because I think that historically have worked very well in the Web 2 world. Like okay, whatever works in the West, in Silicon Valley, you copy paste it, put it into India, put it into China, it all works, right? They all make a tons of money. But in crypto, a lot of very bright people have attempted that, and somehow most of them actually it doesn't work. I mean, just to give an example, no finger pointings or whatever, but I think that we have seen actually at least five extremely high profile successful Web2 entrepreneur trying to do a Web3 startup, crypto startup in a skeuomorphic way, and it doesn't work.
Yeah.
And it end up in a disappointment. Like for example, one of the pretty high profile Solana NFT marketplace, I shall not name it. I don't think anyone is talking about them anymore. And it was the co-founder was one very famous Web2 entrepreneur that exited a $1 billion startup. And obviously, that's not the only example. You also have Moonbird. I don't want to go into the details as well, etc. Right? There's so many of them. So I'm more and more bullish on Web3 gaming that is non-skeuomorphic in terms of the design, like something like a Pump.Fun, Fantasy Talk, this kind of thing that's really applied to the small group of extremely enthusiastic players and user and expand from there. I think that is something that will create more success in the medium term. But most of these are still in the private market side. We are not seeing enough of that in the public market. But on the public market side, we see some games that have proper traction, are actually playing out exactly like what we have described in our Web3 gaming thesis described 2 years ago. I think Pixel is actually doing very well. I'm not sure why market is not paying enough attention to them. They have consistent 700 to 800,000 daily active users. There's some incentive component, but it's not like Axie last cycle. You can't really make a living out of just playing the game. And I've known a lot of the non-crypto native people playing the game just for the sake of playing the game as well. So these are the sectors we continue to be excited on. And I think this is something from a non-US perspective that there's a huge push factor in Asia right now to Asian gaming entrepreneur to build on crypto. Because, for example, the China side, is ultra competitive. They're restricting from publishing a lot of the game for various reasons. They cannot get the license or like the content censorship, etc. So to them, coming into Web3 where such restriction doesn't exist might actually be a better area for them to focus on. And actually, this is like a thesis of Folius Ventures, a very good friend of mine, Jason from Folius. That is most of his thesis. Bright Asian entrepreneur are gonna build something in Web3 because they can't do it in Web2 space. I think this is something that a US-centric guy usually won't observe because you don't really have that issue there. Another side, I think DePin is, I think when it comes down to first principle, this is actually what crypto economic incentives are best fitted at, to bootstrap a network that would otherwise not exist because of the existing incentive structure or market structure. Like what Helium does, I think it's like been well popularized. You use like a decentralized peer-to-peer network to bootstrap an infrastructure that would otherwise be too expensive for many centralized single party to bootstrap. But you use token where everyone can participate in the upside. So most of the DePin are using the same principle to bootstrap a certain network that would otherwise not exist just because the incentive structure doesn't make sense. But obviously, we are going to see a lot of failure there. But I think some of the winner there are going to bring like $100 billion outcome. Yep.
Yeah. Arthur, I have a game pitch for you. Here's the game I want to see built, which is I like old games like chess, and like I'm not a big player of like Call of Duty or anything like that. I like Tetris and chess and games like that. What I want to do is be able to wait to play a friend online. Like I want to be like Sean, like I'm challenging you to chess and be able to bet. Like I bet one of my Pudgy Penguins, he bets one of his Pudgy Penguins, and then you let everyone on crypto Twitter watch that game. And the crypto Twitter crowd can bet on us. They're like, they can bet on like me winning the chess game. They can bet on Sean winning the chess game. Whoever wins that game wins the NFT. That's my pitch for you. That I honestly, if anyone's listening and wants to go build that, I would probably fund that. I really like that idea. So
it fits in. It's not skeuomorphic, Arthur. I think that's quite novel for Web3.
Yeah, I think that actually instead of betting, just create a meme coin, because why meme coin take off is you have limited downside, you lose all your money, but you have unlimited upside. It's actually better than kind of like a strict kind of betting game when your payoff is actually limited. So meme coin take off because there's no limit to the upside.
Yeah. All right, guys, I got to jump. This has been awesome. This is I feel like there's a lot that we didn't I wanted to talk about, didn't get to talk about, so we'll have to have you guys back on for round 2. But this has been awesome. Arthur, Sean, appreciate the time.
Thanks for having
us.
Yeah,
cool.
Thanks, Yano.
Hey everyone, Jason here. Thank you so much for watching today's episode. Wanted to take a quick second to thank today's title sponsor, Arbitrum. We know you are tired of on-chain experiences that have unaffordable fees and frustrating transaction speeds, and that's why we partnered with Arbitrum. You can experience frictionless trades, lightning speed, and lag-free transactions, all for pennies per transaction. Explore Arbitrum's expanding ecosystem at portal.arbitrum.io. That's portal.arbitrum.io. See you for the next episode.